In week 3, we're going to take a look at qualified plan rules on the PowerPoint. Now, these rules are important to understand because they are basic in dealing with qualified plans. And qualified plans are very popular with employers because if you follow these rules, the employer can take an immediate income tax deduction in the year of the employer contributions. If the rules are not followed, then the plan is deemed to be a non-qualified plan, and then the employer must wait until the employee finally receives the money before the employer can take an income tax deduction. So these rules are important to understand. Here are the two main types of qualified plans: defined contribution and defined benefit plans. Now, in the defined contribution plans, the plan document specifies by formula how the employer contributions are going to be made each year. And so that's why we call it a defined contribution plan. The contributions are defined by the document. What we do not know, though, is how much that is going to grow to on day one of retirement. Whatever the account balance is, that's what the employee has to work with in retirement. Defined contribution plans also have a limit on the grand total of the employer contributions, employee elected deferrals, if any are allowed, and any forfeiture reallocations that are going into the account for each employee. The limit on that is the lesser of 100% of compensation, or $52,000. And we'll talk a little bit more about that later on. The defined benefit plans have a plan document that specifies by formula how the benefit is going to be paid to each employee who is in the plan. So we define the benefit in these types of plans. What we don't know in this case is what the employer contribution is going to need to be at the start of the plan, and also each year when the actuary comes back to do the calculations and figure out what the employer contribution needs to be for each successive year. So we define the benefit. The employer contribution is unknown in this case, although the retirement benefit is certain. There is also a limit on the maximum benefit or defined benefit that can be paid out, and in 2014 that limit is $210,000. So in retirement this year, a person receiving a defined benefit cannot receive more than $210,000 as the annual benefit this year. Here are the qualified plan limits for 2014, and you will need to memorize these for the midterm and final exam and for the CFP exam. The CFP board does not provide these numbers in the exam booklet or on the exam screen that you'll see when you take the test, and so I don't provide them either because I want you to start memorizing these things. So here are the limits you need to know. And one thing that's important to also understand beside these limits is that there is a maximum amount of compensation that can be considered or plugged into the qualified plan formula. And for 2014, that amount is $260,000. So for example, if there's a 10% employer contribution into your money purchase plan, and we'll study these later, they do not take 10% of the $600,000 in my example that you make and put in $60,000. Instead, they put in 10% of the $260,000 that is part of the $600,000 you make because of the compensation limit of $260,000 this year. So it's 10% of $260,000 is the maximum that can go in for my example. That would actually be further limited if it's a defined contribution plan, because as you can see there, for each participant, the maximum contribution that can go in because of the annual additions limit, also known as the Section 415C limit, is the lesser of 100% of compensation or $52,000. You cannot have more than $52,000 going in for any employee. The grand total of the employer contributions plus employee elected deferrals plus any forfeiture reallocations to the account. In a defined benefit plan, for each participant, they cannot get a defined benefit greater than 100% of their compensation or $210,000 in any retirement year. For employer funding in a defined contribution plan, The most that an employer is allowed to put in is 25% of covered payroll. Covered payroll means the total compensation payroll for those who are in the plan. In a defined benefit plan, the employer funding is going to be the amount that the actuary says is needed each year to fully fund all of the retirement benefits. According to ERISA, which is the Employee Retirement Income Security Act, qualified plans are not allowed to discriminate unfairly against the rank and file employees, or the non-highly compensated employees, or the non-key employees. So here we have two categories which we call favored groups that can be important in doing this testing to make sure a qualified plan is still qualified. Because if a qualified plan loses its qualified plan status, the employer is still required to make the contributions, but the employer cannot then deduct the contributions until the employee receives the benefits, because then the plan would be considered a non-qualified form of deferred compensation. So here are the two categories: highly compensated employees and key employees. We take a look at highly compensated employees for the non-discrimination testing, which must be passed for a qualified plan to remain qualified. We take a look at two categories: the highly compensated employees, and compare how well they're getting benefits to the non-highly compensated employees. So we need to know who were the highly compensated employees. Anybody who is more than a 5% owner of the company is automatically a highly compensated employee. Also, any employee whose compensation last year was over $115,000. And a company is further allowed to rank all the employees from highest to lowest in compensation, and to just have a cutoff point where you reach the top 20% of employees. So in a company that has a lot of people paid more than $115,000, they can make the selection to just count the top 20% of employees by compensation, even if there are still many more on the list below that cutoff point who are making more than $115,000. So highly compensated employees we use for the ratio percentage test and the average benefits test, which we'll cover on the next slide. The key employee favored group status we use for top-heavy testing. And when a plan is top-heavy, which means more than 60% of the benefits are accruing to the key employees, there are certain extra things that need to be done for the non-key employees. A key employee, just like the highly compensated, is an employee who is more than a 5% owner. A key employee is also a person who owns more than 1% of the company and has compensation in excess of $150,000. A key employee is also an officer of the corporation who has compensation greater than $170,000. So remember, key employees are used for the top-heavy testing, and the way to remember that is if you held a key on top of your desk and let it fall, it would fall because the top part is top-heavy. And highly compensated employees are used for the non-discrimination testing. As I've said before, qualified plans must pass non-discrimination and coverage requirements to remain qualified so they can continue to currently deduct the employer contributions that are required. A qualified plan must first of all take a look at who is ERISA eligible to be in the plan, and that would include any employees who are at least age 21 and have served with the company for at least 1 year. We call that the ERISA Basic Age 21 and 1 rule. That is the census we use to determine the ratio percentage test or the average benefits test. Every qualified plan must pass one or the other test, ratio percentage or average benefits test, and defined benefit plans must also pass one additional test called the 50/40 test. So we take a look at our census of employees and only look at the ones who are at least age 21 and have had 1 year of service with the company. We then design the plan based on those employees, and generally on the exam the viewpoint is that the owner is trying to maximize his or her benefits and minimize the benefits of the rank and file. So it is possible to exclude people who are located at branch offices. You can also try and exclude people who are paid, for example, on an hourly basis instead of a salary. But that is only going to work if you can still pass the ratio percentage test or the average benefits test. Let's look at the ratio percentage test first and how it works. We take the ERISA eligible employees, age 21 with 1 year of service at least, and break them into two camps: the highly compensated employees we saw from the last slide and the non-highly compensated employees. Let's suppose we have 4 highly compensated employees and all 4 of them are in the plan. That is 100% participation. The rule is, to pass the ratio percentage test, we take the percentage of highly compensated employees, and in my example that's 100%, and multiply that times 70% or 0.7. 0.7 times 100% is 70%. So we would then calculate how many of the ERISA eligible non-highly compensated employees are participating in the plan. If that amount, according to our calculation, is at least 70%, then our plan passes the ratio percentage test and it can be qualified. Another test that can be passed if you don't pass the ratio percentage test is the average benefits test. Here we take a look at what the real percentage everyone is getting. For example, if our 4 highly compensated employees are each receiving a 10% benefit, such as a 10% profit sharing plan contribution by the employer, we add up those amounts and it averages out to 10% for our highly compensated employees. To pass the average benefits test, we take 70% of that amount. So 70% of the 10% the highly compensated employees are getting would mean that we would need to get an average benefit of 7% for the non-highly compensated employees. If we do reach that level, the plan passes the average benefits test also, although we just need to pass one of the two.